Welcome to The Marcus Warren Show, powered by 960 Digital and the Wealth Empowerment Network. Now, here is your host, Marcus Warren.
Good morning, good afternoon, good evening, and welcome to the number one retirement and tax planning show in the region, The Marcus Warren Show. I am your host, financial advisor, tax enrolled agent, and author of the Retirement and Tax Playbooks, Marcus Warren. And I hope everyone is doing well on this Sunday. And to my left, I am joined by our resident tax professional, Dee. How you doing, Dee?
Hello and happy Sunday.
And remember that if you miss any parts of the show and you want to catch up on anything you missed, all you have to do is subscribe to the Marcus Warren Show podcast via Apple Podcasts, Spotify, or wherever you get your podcast. Also, throughout the show, we will be offering our retirement rescue game plan. Now, you may be asking yourself, what is that? Well, if you're new to the show, let me tell you what it is. It is a physical packet of information that will help rescue your retirement from all the risks that threatens your nest egg once you are close and in retirement. Now, in that game plan, you'll get a copy of my 2 books, a few different financial reports, and access to my webinar entitled
Taxes in Retirement.
Yeah, we did a little new thing right there. If you're new, you don't know that was new. But anyway, how can you get that retirement rescue game plan? You can simply go to warrenwealth.net. You go to the site, put in your information, and that retirement rescue game plan, recession retirement rescue game plan will be delivered free of charge to your front door. Once again, all you have to do is go to warrenwealth.net. All right, on to the show. Let's get into Money Matters.
Here comes the money.
Here we go. Money talk.
Here comes the money. Money.
All right. So, we've been kind of in this, I call it a superfecta. And I've said this before on the show and a few times. We're in the superfecta of, bad things in our economy. And, I'm in Louisville, Kentucky, and people like to bet on the ponies. And you can...
Home of the Kentucky Derby. And many people haven't heard about the Exacta. That's when you hit the first 2 horses. You pick the first place winner and the second place winner. Most people have heard of the Trifecta. That's right.
You pick the first, second, and third place horses. And then last, there's a Superfecta. And that is when you pick the first, second, third, and fourth place finishers right there in a row. And so we right now are in this superfecta. There are 4 things right now that are going on at the same time that have a lot of people uncertain about what's going to happen with their finances, what's going to happen in retirement, and I want to talk about those things. So the first thing we have is this record inflation, right? 40-year high inflation. Things have gone up and up and up. The price of groceries and gas and almost anything now, if you're trying to build a home, whatever that may be, all the materials, everything is high right now. And that has been really devaluing our dollar. Now, I'm not talking about the strength of our dollar in relation to other currencies. I'm just talking about your dollar now doesn't go as far when you go to the Piggly Wiggly these days. That's a grocery store if you didn't know what that was.
Okay.
And so we have this record inflation. That's number one. Then we also have these rising interest rates. And I say it all the time is that the way that the Fed and the government tries to attack inflation is by rising interest rates, by trying to suppress spending and slow the economy down. All right. And they do that by raising interest rates. And so we are in this rising interest rate environment, and it is so new to so many people who have been living in this utopia of these low interest rates. And, for the last, few decades before, this last decade or so, interest rates were generally at levels where I know that, about 20, 25 years ago, just looking to get a mortgage on a house, you were looking at about a 7 or 8% interest rate. And if you go back to the 80s, we have clients who had 14% interest rates on their home, on their homes, right? And we are finding ourselves where now mortgage rates have doubled, over the last 6 months, and now mortgage rates are around 6 or 7%. And so we find ourselves in these rising interest rates environment, which, by the way, higher interest rates are bad for consumers. Because if you're buying something, you're on your credit card, you're trying to get a car loan, you're trying to get a mortgage, those interest rates are high, and that's bad. Eventually, as the banks start letting these higher interest rates seep into their CD rates and their bonds and their savings accounts, rising interest rates are good for savers, because now you can go to the bank and actually get a good rate. Where before you go to the bank and you could get 0.001% on your savings account. And now when interest rates rise, now you may be able to get more bang for your buck at the bank. All right. So we talked about the Exacta, record inflation, rising interest rates, 1 and 2. Let's go to the third one. So we are in a bear market. The stock market has been down pretty much all year and will probably end down unless something crazy happens over the next few weeks or so. We are going to find ourselves in this bear market. A bear market is basically when the stock market is about 20% off of its peak. And that is where we are now, especially with the NASDAQ, the S&P 500, things of that nature. And that has shook a lot of people, because generally when the stock market takes a hit, people can run to bonds and find good fixed income and find safety there. But unfortunately, with these rising interest rates, bond prices have started to go down, because interest rates and bonds have an inverse relationship. So as interest rates go up, bond prices go down, and it happens to be at the same time that the stock market is going down. So all of Wall Street right now is going down. All right. And then the last thing we have, which makes it the Superfecta, is, folks, we have a dark cloud hanging over our heads called a recession. We are headed into a recession. Now, the people out there in Washington have politicized it, so they don't want to say that we're in a recession. But if you look at the tea leaves and you watch what corporations and these large companies are starting to do, they are starting to tighten their belts. They are starting to spend less. They are starting to lay people off or have hiring freezes. They are cutting advertising and marketing. They are getting ready for a slowdown in consumer spending, which affects the economy. And so those are the four things, the Superfecta, that is all hitting us at once. And it really is causing a lot of uncertainty for a lot of different investors and retirees. My daughter is asking about why are prices so high. She lives out in Chicago, and her car's out there. She doesn't drive much, luckily, because they have a good public transportation system. But when she does, she is spending a lot of money at the pump, and she keeps asking me, when are these prices going to go down? And I'm like, I do not know. Hopefully sooner than later. I have people who I sit across from, families that I sit across from, and they're asking me about interest rates. When will interest rates go down? And the one thing that I tell them, and I kind of hinted at that here a little earlier, was the fact that we have been in this interest rate utopia. I don't think interest rates are going to come down anytime soon. I think that as they go up, once the Fed finds that balance, I don't think that all of a sudden, in the next quarter or the next few months, they're going to say, oh, everything's cool, let's make money cheap again. Because if you look historically at interest rates, they had never been that low for that long. That was an anomaly. Like I said, this utopia, this fantasy world that we were living in, and people were able to take advantage of for almost 20 years, because they started bringing down interest rates right after the 9/11 attacks, right, in 2001. And that's when they started to come down, 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 down. It created this bubble. And of course, that real estate bubble, that credit market bubble. And then in 2008, it burst. And we were on financial collapse. So they weren't going to raise interest rates anymore. They just pumped more money into the market, kept interest rates low, and then here we are again, where we had this high inflation. And now they're raising interest rates, and I don't really think that once they get to a level that they see the economy getting better, that they're all of a sudden going to drop them again. I think we need to get used to what the norm was back in the day. it's kind of like gas prices,
Right.
I'm going to date myself here, but I remember when gas was under $1 for a gallon.
Wow.
Nice.
Okay.
And then they give you that initial shock. Gas prices go up and they jump up to, $1.70. And you're like, what the heck? $1.70? And it's $1.70 for a couple of months. And then they bring it down to $1.20. And you're like, whew, I'm so glad that it's $1.20 now. When you used to pay less than $1 for it, but now you're coming from $1.70 back to $1.20. And they've done that up. They've ratcheted that up and up and up over the last few years. And of course, now if gas prices were to get back down to $2.50 or $3.30 or
wild.
yes,
Yeah.
we would be happy because
Ecstatic.
they're at $4 and $5. They were at $4 and $5 at one point. So once it settles back in at about $3 or so, we'll be happy when we were probably paying $2.75 before that. And I think interest rates are the same. We're shock. They'll go up, then they'll be 8 or 9%. Then they'll come down to 5 or 6 or 7%, and we'll be happy again. That's why I don't think that interest rates are going to go down to those low levels anytime soon. All right, you're listening to The Marcus Warren Show.